Imagine this. It's Berlin, November 1923. You're standing inside a small neighborhood bakery. The air smells like fresh bread, but no one looks relaxed. Behind the counter, a chalkboard lists the price of a single loaf, 200 billion marks. Not 200, not 200,000, 200 billion. The woman in front of you isn't holding a purse. She has a wheelbarrow filled with cash. Not groceries, cash. By the time you finally reach the counter, the baker calmly wipes the board clean and rewrites the price, 250 billion marks. In the time it took you to wait in line, your money lost a third of its value. This isn't fiction. It happened, and it has happened again and again. Zimbabwe, 2008 banknotes printed in denominations of 100 trillion just to keep daily transactions alive. Venezuela, 2018. Everyday groceries costing millions. Lebanon, starting in 2019, a currency losing nearly all of its purchasing power within a few short years. Here's the uncomfortable truth. The real question isn't if a fiat currency fails. Historically, the question is when. Across modern history, paper currencies follow a familiar path. Governments spend more than they collect. Debt grows. To bridge the gap, money creation accelerates. Inflation rises. Confidence fades. People rush toward alternatives. Eventually, the system resets. The pattern isn't mysterious, it's mechanical. So when money collapses, what actually survives? Looking at a century of monetary breakdowns across continents, the evidence is remarkably consistent. Certain assets repeatedly preserved purchasing power, others were wiped out completely. First, precious metals, gold and silver, are often criticized because they don't produce income. They don't pay dividends or generate cash flow. But that criticism misses their purpose. Their job is not to grow wealth during stable periods. Their job is to survive unstable ones. During Germany's hyperinflation, holding paper marks meant financial destruction. But gold maintained its purchasing power relative to real goods. The currency changed. Gold didn't. The same pattern appeared in Zimbabwe and Venezuela. When local money became nearly worthless, gold retained value in terms of food, fuel, and tangible goods. The reason is simple. Governments can print currency. They cannot print gold. When the supply of paper money explodes, each unit becomes less valuable. A scarce, tangible asset that cannot be created at will rises in relative value. Gold is not magic. It's mathematics. It acts as monetary insurance, not speculation. Insurance against systemic failure. Second, foreign hard currencies. When a domestic currency weakens, people don't wait patiently. They move towards something more stable. In multiple currency crises, citizens who held savings in stronger foreign currencies preserved far more purchasing power than those who kept everything in local money. This phenomenon is known as currency substitution. When trust erodes, people naturally adopt alternative currencies for savings and trade. It's not political, it's practical. Access to a stable foreign currency during domestic turmoil can act as an escape hatch. The key isn't blind loyalty to one currency. It's diversification beyond a single fragile system. Third, productive equities ownership in real businesses. This surprises many people. In some hyperinflationary environments, stock markets have surged dramatically in nominal terms. That seems irrational at first. How can stocks rise while the economy struggles? Because a stock represents ownership in real assets, factories, land, equipment, inventory, intellectual property. When currency loses value, the price of real assets adjusts upward in that currency. It takes more units of money to equal the same real-world value. However, not all companies are equal. Businesses earning revenue entirely in a collapsing domestic currency often struggle in real terms, but companies generating income from exports or foreign markets may remain resilient. If revenues are earned in stronger currencies while some costs remain local, real profitability can even improve during devaluation. Ownership in productive, globally connected businesses has historically been far more durable than holding idle cash in a failing system. Fourth, essential goods and barter assets. When monetary systems freeze, trade doesn't disappear, it reorganizes. In severe disruptions, tangible necessities, food, fuel, medicine, batteries, basic supplies become directly valuable. In certain historical crises, even everyday items functioned as temporary mediums of exchange. These goods provide short-term resilience, but they are tactical, not strategic. Consumables are used up. They cannot store wealth for decades. They offer immediate security during acute instability, not long-term preservation. Fifth, productive agricultural land. When financial systems falter, food still matters. Land that produces crops or livestock has intrinsic utility. People must eat regardless of currency conditions. Throughout history, those controlling productive farmland often retained a base level of security. But land is not risk-free. It is immobile. It can be taxed. In extreme political scenarios, property rights can be challenged. Its resilience depends heavily on legal stability. Still, productive land tied to real output has repeatedly demonstrated underlying value during monetary turbulence. Now consider what consistently fails. Fixed income assets denominated in the collapsing currency, government bonds, domestic debt instruments have historically suffered devastating real losses. If you are lending money to a system that is rapidly expanding its money supply, you are being repaid in units that are losing value. Likewise, savings accounts held entirely in domestic currency within distressed banking systems have often experienced massive erosion in purchasing power. The number in the account may stay the same. The value behind that number can vanish. Being a creditor to a weakening currency has repeatedly proven to be one of the most vulnerable positions. Currency collapses rarely appear overnight without warning. They tend to move through stages: persistent deficits, rising debt, accelerating money creation, increasing inflation, declining confidence, capital flight, and eventually systemic reset. Different nations move through these stages at different speeds. Some stabilize, others spiral. The lesson is not panic. It's preparation. No currency in history has been permanently immune to pressure. Economic leadership has shifted between nations before. Reserve currencies have changed over time. Systems evolved. The rational response is diversification across asset classes, across currencies, across jurisdictions. Concentrating everything in one country, one currency, and one asset type creates concentrated risk. History does not reward blind concentration in fragile systems. When currencies fail, certain categories have repeatedly shown resilience: precious metals as insurance, stable foreign currencies as alternatives, productive export-oriented businesses, essential goods for short-term disruption, and land that generates real output. Meanwhile, domestic fixed income claims and idle cash inside collapsing systems have often faced severe real destruction. Monetary systems are human constructs, and human constructs can fracture under pressure. The people standing in that Berlin bakery didn't think they were witnessing history. They were just trying to buy bread. But the difference between ruin and preservation has rarely been luck. It has usually been positioning. History leaves patterns. The only real question is whether we recognize them early or whether we notice them only when the price board changes while we are still standing in line.